What is up, everybody? Logan here again with another video coming at you guys. And today I'm joined with Vance again. Vance just started his YouTube channel as well, and you can find the link to that down in the description. So I'm excited for him to start posting some videos to help you guys out. But in this video, we're going to go over the 0DTE width comparisons. We have a lot of questions in the Discord as of lately on should I go 5 wide, 10 wide, 25 wide, 50, maybe 15. And we're just going to show you guys basically like the expectancy when you do that. And then also you have to look at risk reward a lot of the times when you're playing something that's odds based. So I really appreciate you coming on again, Vance, in this video. I'm excited for your channel, and I'm going to take a little bit more of the back seat on this video as you explain to them your width comparison and show some charts.
Hey, not a problem, Logan. Thanks for having me on.
Mm-hmm.
So yeah, one of the things that happens is we get a lot of questions often about, should they go 5 wide, 10 wide, 25 wide, 50 wide? Tammy Chambliss is really big with her super wide low deltas. So I wanted to kind of go over a comparison of width, and then on top of that, talk about the differences between trading with a stop loss and trading versus a roll, because that's a very common question as well. So the first thing that you need to know about options trading in terms of prices is this. If you take the price value that they give you in credit for an option, right? So let's say up here, this is a 5 wide, it's 35 credit, right? So if you take a $35 credit, right, and you divide that by the width, right, the number you get back, I'm going to turn this into a percentage, right? That's 7%, right? So what they're telling you is that, I call this the spot odds, because it's the odds at that particular point in time, but it's going to change during the day, right? Mm-hmm. They're giving you a 7% spot odds that this trade will expire in the money, right? So you have a 93% chance it'll expire outside of the money, right? And that's just because the stock market is basically just a gigantic gambling roulette machine in terms of pricing, right? I'm not saying that's how we should use it, but in terms of pricing, that's how everything is figured out. It's all done by odds. Mm-hmm. Okay. So if you're one of these people who subscribes to the belief, which is not correct, that delta equals odds out of the money, and that delta doesn't actually calculate odds for starters, right? It's used as a placeholder, because if you do the math for calculating odds, right, the number you get is pretty close to delta, but that only is on trades that are more than like 7 days or longer to expiration. Once you get inside 7 days or less, it just doesn't sync up anymore to any degree of certainty, right? So, but let's pretend for the sake of this discussion that they do match up. So if you're getting paid 7%, right, on a 5% trade, a 5 delta trade, that's a good trade, right? Because you're getting paid 7% odds for something that's 5%. So, but we're going to go into a little bit more depth of why we want to be careful with different things and why we need to use expectancy. So since we know that the credit value you get divided by the width, right, gives you, and it's width times 100 because there's 100 contracts. So since we know that, right, and we can figure out what our spot odds are for any particular trade, we know we can get an idea of whether or not a trade overall is safe over time. So what I've calculated out here, and I'm using today is Sunday, right? So the market's not open. I'm using tomorrow's numbers as a metric because that's all I have available to me to use, like a real-time type thing. So I'm going to use some of tomorrow's odds-based numbers as a metric. What I've done before the video is I've gone back and I've pulled the average credit received over the course of a year at open for different width contracts, right? So assuming this is all a 0.05 delta trade, right? Because I had to come up with a standardized metric, so that's what I chose. I chose the Tammy trade, right? So if at a 5 delta trade, if you're doing a 5 wide, the average credit received is $35, right? If you do a 10 wide, you get 65. A 25, you get 140, and a 50, you get 185, right? What we're going to do now is we're going to take out fees and commissions, right? So for one contract, even though the width is wider, you're only paying one set of fees. So I'm subtracting out $4 from each one of those contracts here. And then what I'm going to do is to calculate things correctly, we have to normalize the price for a 5 wide. So that way we're comparing it all to the same thing, right? So then what I'm basically doing is I'm taking the amount of credit received and I'm just dividing it down, by whatever the width factor is, so that everything is essentially a 5 wide contract. That's you're getting your credit based on that, right? So yeah, you're getting $185 for this 50 wide, but when you divide that by 10, you're only getting this. You're only getting $18 for the entire width per 5 points wide.
Mm-hmm.
Okay. So this is where the math starts to get important as to whether or not you want to take profits, you want to close with a stop loss, or you want to roll. Okay. So what we advocate is rolling. And the reason why we advocate that is this. If we make the assumption, right, that this delta, this 5 delta is risk, right? So that means you have a 95% chance of it being out of the money, and you have a 5% chance of it being in the money at close, right? Those are good odds, right? But here's the problem. First thing you have to remember is that touch, which means that the price will touch your strike, is approximately twice the in the money factor. So if your in the money is 5%, right, that means your touch is 10%. So immediately right away, what that means is that the trade you're looking at is the short strike is going to get hit twice as often as it actually expires in the money, right? So 9 times out of 10, you'll be fine, but there's that 1 time out of 10 you're going to get touched. Here's the other problem, is that if you're operating with the stop loss versus the roll, here's what happens. I calculated out based on the theoretical numbers, and I have to go off of the theoretical numbers that Tastyworks and Thinkorswim give me for what the stop loss range would be. So there is a degree of give or take here, right? Because volatility could go up, volatility could crash. The stop loss levels at 3 p.m. are not going to be the same as they are at 10 a.m. These are all things that I know, but we have to just kind of come up with a here it is level and use it, right? If you were assuming a 3x stop loss, that means that on basically any one of these trades on an average of 83 points down, you would hit your 3x stop, right? On a stop loss to the top side, to the call side, it's anywhere between 55 to 59 points. So we'll say 57 for the purposes of averaging, right? So you have 83 down and you have 57 up. Those are your averages. Well, when we go back and throw this into the options chain, that changes, right? You're down and you're up level, right? The strikes where you would stop out at. Well, those have different deltas entirely, right? So on the downside, that's an 8 delta, right? And on the upside, that's a 9 delta. So here's the caveat, right? An 8 delta is going to get touched 16% of the time, right? Yep. That is 6% more than your baseline trade, right? Because you have a 10% chance here, but this downside stop is 16. So you immediately have a 6% less chance because you're going to stop out. And that's to the bottom side. To the top side, the delta is a little bit higher, right? It's a 9%, a 9 delta, which is an 18 touch, right? So when you enter into this trade, right, because you're going to operate with a stop loss, you've automatically tripled in reduction your odds, right? Because you had a 5% chance of losing at the start, right? Because that's why you picked this low delta setup, because you only had a 5% chance of losing. But immediately, because you have a stop loss and you're going to close, because the way a stop loss works, you have to operate on touch, right? That's what it means, is when it hits those strikes and the price value equals X, you're out. So you have to operate on touch. So immediately going into this trade, because you have a stop loss, you've gone from a 5%, from a 95% winner, right, to an 84% winner on the put side and an 82% winner on the call side. If you were to get the correct spot odds, right, to get paid correctly to take those particular odds, you should be getting an $80 credit or a $90 credit. So we'll say $85, but you're not. You're getting 31 after fees. So what ends up happening is when we calculate expectancy, right? And win-loss rates, you can throw them out the window. They're fun to track, but if you win $5 every time you win, right? And you lose $10,000 every time you lose. If you win 99% of the time, but lose 1% of the time, you're way upside down, right? Because you have $495 here and you're minus $10,000 here. So win-loss only makes any matter if the percentage of money that you win when you win outpaces the percentage of money you lose when you lose. That's otherwise win-loss. That's why we deal with what we call expectancy. Over time, given the win-loss rate and what we win when we win and what we lose, what is the expectancy of profit or loss? So you either have a positive expectancy or you have a negative expectancy. And that's why it's a more important thing to calculate, right? So this is one of the reasons why we don't operate with stop losses. We operate with rolling, because when you roll, right, you can actually use this percentage, this touch percentage as your baseline. You can say, all right, unless our short strike gets touched, we're not even going to consider doing anything to this trade. If it does get touched, we will consider managing it depending upon the time of day or the situation that we're in. Because you could go into the money, 5-10 points and come back out. It counts as a touch, but then you're safe, right? And that's happened. So I'm going to show another metric here in a minute to kind of explain why that's happened. So, but if you roll instead of a stop loss, you can actually use the touch of the odds versus the touch of the stop loss, which will always be a better place to be. Plus, if you roll when you're at this touch level, you can, and as long as both contracts aren't in the money, you can almost always roll, receive a credit, just roll out one day, receive a credit, and roll down or roll up depending upon the direction that you're in. If you're a call, you want to roll away from the numbers, but you can almost always roll away, right? Give yourself a little bit more of a buffer room and still collect a credit without widening, right? You have that ability. If you take a stop, right, you're out two times what you got credit for, right? Because if you got in for 35, if you stop out at 3x, which is 105, you've lost $70, period. And if you stop out 3 or 4 days in a row, it starts to really add up. Never mind the fact that we can go into this too. Like when you start to normalize these prices, right, per 5 wide credit spreads, like this 25 and this 50, I mean, these are abysmal credits, right? When you look at it, you're basically getting $20 take home. That's if you close it, right? If you close it. If you don't close it, you're taking $27 home, right? So you're literally risking 94% of your account, almost 95% of your account to make 5%. Like it's not abysmal, but it's not a great risk to reward. Most credit spreads are going to be 9-1. That's just how it is. But I mean, you're upside down. You're just radically upside down. So, the other part I wanted to show and talk about, and this came from a conversation I had with somebody else the other day, and this is why this is important, is because we want to talk about the market's volatility, the market moving, right? So I ran a quick little study using the open close values of the day up and down. And basically what we wanted to look at is, how often did the market move 50 points, right? And what is 50 points? So 50 points is usually on average for the past 2 years, right? Because I ran this since January of 2021, which is honestly when a lot of people started trading because of COVID and other metrics, right?
Mhm.
So for the past 2 years, right, that's a 1.2% move on the day, right? So that from historical numbers, from historical data, we know that that's going to happen about 70% of the time, right? So if you're outside of if you're below 50 points, if you're below that 1.2%, like you're going to get caught a lot, right? And that's just from the open metric, from whatever this number is at open, up 50, down 50. Well, here's one of the things we wanted to track, and this kind of goes to show like how volatile this year is. In 2021, the number of times that the market opened and went up 50 points and touched a high of 50 points above the open was 26 times, right? It touched the low 50 points below the open 24 times.
Mhm.
It closed, open to close, more than 50 points 24 times. And here's a crazy number, right? There were 13 times where the market actually went up 50 points above the open and it went and touched 50 points below the open. So it actually had a 100-point swing, top to bottom during the course of the day, irregardless of the close. So if you're trading one of these far outside the money credit spreads, right? These five deltas, you have to come into the understanding that your stops are going to get touched a lot, right? Because when we went back here, we calculated, right, that the price level for a 3x stop loss was 57, right? We calculated this as 57 to the top side. The downside, you had a little bit more room, but to the top side, you had 57, right? How many of these taps to the top, right? The 26 in 2005, right? I didn't track 57. I could go back in and rerun it, but that probably happened, 18 times where you actually went in the money, right? Regardless of whether or not it ended in the money, you would have gone in the money. 2022, these numbers are insane. It touched the high of 50 points above 60 times. It touched the low 50 points below the open 74 times. It closed above or below 50 points 82 times. And it hit both 50 above and 50 down. So again, that 100-point swing 46 times. There's 250 trading days in the year, approximately. It usually could be 251 on some years.
Mhm.
So 46 out of 250 is dang close to 20%. It's like 18.9%.
That's crazy.
So just going into it, looking at that, knowing that you've got a 20% chance out the gate on at least this last year of getting tapped with that low delta strategy.
Yeah.
So that's why we roll, because we are aware of the metrics. We're aware of the danger and how often these things get touched, right? So if you're just going to constantly stop out with low credit trades and stop out with low credit trades, you're going to bleed out your account. It's going to happen. And I know there's people out there that will say, well, Tammy Chambliss is up 10% a month, or this person hasn't had a losing trade in 2 years. Like, I'm, without being a jerk about it, post an actual P&L statement of all your trades. I don't believe you. I want to see them. When you post it and you can prove that these statements are true, then there's some degree, then I'll eat crow, right?
Yeah.
But the mathematics of the situation say it's a lie. It's not the case unless you're doing something else, unless you're trading some other way than what you're saying, right? Because all the little defenses that people will put up there, like, oh, wait 15, 20 minutes into the open, right? Then make the trade. Well, you had a 100-point swing, son. So if you waited 20 minutes into the open, one of your two sides got tagged, if not both. Maybe one didn't, but the other side did, because it was a 100-point swing.
Yeah.
And that happened 82 times this year. So that certainly isn't the answer to the question. I'm sorry. It happened 46 times this year. But still, that, like I said, that's not the answer to the question, right? That's anything that you're saying is BS, to put it succinctly.
Yeah, 100%. Like that's one thing I've always done is I always show, my account statements. I always show people the trades, like the actual trade history, just to show them like from the way that I do it and the way that we do it, here's your expectancy. And I always talk about expectancy as something that's super important is like there's so many people who always feel like that urge to have a trade on. And it's like
Yep.
you put a trade on a couple of the days that the criteria didn't call for it just because you felt like it. And you're doing the very low delta, very wide, like you initially started 20 wide and you got, I don't know, $100 for 2000 at risk, right? You're just looking at such a different game than following the same routine that you've done every day just because you felt like that was the right thing to do at that time. So
Yep.
that's another thing because like I sometimes would do 10 wides and I understand, right? Like the difference between a 5 and a 10. I've never started a position at 25 wide and I've never started a position at 50 wide where I was like, all right, I'm gonna my first time I'm putting a new trade on, let's risk 5,000, and then collect X amount of credit, right? Whether it was
Yep.
180 like you were showing or 200. Um, and then the management also becomes much more difficult as well. So that's also
Absolutely.
that we touched on today as well. And I try to do in all my other videos. Is that everything you wanted to go over in this video?
I do believe it was, sir.
Awesome. Well, that's going to be everything for Vance and I. I hope this helped you guys out with your trading and also thinking about how you want to trade credit spreads or zero DTEs in general and just focusing on your actual risk to return because a couple percent, difference in your actual risk versus, going wider and having worse chances, right? When it comes to having a wider spread just over time, if we normalize it for the $500, that's something that you need to take into consideration with your trading because your performance is going to be dramatically different when you just have a couple percent's worth of an edge. So, especially in a market like this one where it's constantly ripping up and down, and credit spreads are kind of difficult when that's the case, just because it is easier to get tested. But at the same time, we have the metrics on our side showing us, hey, here's the best way to do the strategy, and here's what you should expect over time.
For sure. And I know you mentioned earlier at the top of the video, but just a reminder, I started my YouTube page.
Mhm.
It's called By the Numbers. There's no E in numbers for reasons, but Logan's going to drop a link in the description. I would appreciate if you find any value in these videos and my rants. There's going to be more of that type of stuff to come. I would appreciate you hopping on over there, watching the video that's out, liking, subscribing, all that other fun stuff. And I look forward to bringing some more content. It's going to be kind of analytical rich in nature because that's kind of the direction I like to go things. But I do plan on bringing a lot of training and a lot of intelligent discourse to the YouTube world, and hopefully it'll provide some real value to a lot of people.
Awesome. Well, I'll have that link down below. I'm really excited for you to start your journey. That's been everything for us, and we will see you guys in the next video.